My name's Nyesha McCauley, and you're watching AccessTV.org.
Good morning again. This is Jonathan Small, host and producer of Face to Face. And Face to Face is a program that's broadcast every single week here at AccessTV.org studios in downtown Hartford. Face to Face is a show that's designed to ask my guests the hard questions and give you the answers and information that you deserve to know. This morning on Face to Face, I have an individual in the banking industry. We're going to talk about financial wealth or wealth management. And recently with the latest record Powerball drawing, I'm going to also address some issues on what you need to do if you happen to be fortunate enough to win that type of money. This morning on Face to Face, my guest is the Vice President and Senior Marketing Programming Manager for Webster Bank, Stephen Taylor. Good morning, Stephen. How you doing? Good morning.
Thanks for having me. I'm doing well. Thank you.
Okay, it's good to have you down here. Stephen, your position as a Vice President, Senior Programming Marketing Manager consists of what?
It consists of many things. It's really to give the bankers who are working out of the banking centers the proper tools and resources to attract a certain segment and to attract new households and retain the specific customers that they have by deepening the relationships with products and services offered through Webster Bank.
Okay. Let's kind of jump into our conversation.
Sure.
First of all, how important is financial wealth and financial security, in your opinion, in our society today?
It's very important. The most important thing is planning for the future. Mm-hmm. A lot of people just worry about that specific time at hand and how they're going to get by a certain moment that's kind of more recent and not long term, mm-hmm. More near term. So really planning out and budgeting to make sure that you're setting yourself up properly for the future, not only for yourself to get to retirement and to reach certain life goals, but also if you have any family members, children specifically, who you want to make sure are set up for, unfortunately, when you do pass away, that they're set up accordingly and able to, manage not only the expenses that come along with you not being here any longer, but in order so they can continue their livelihoods as well.
Stephen, is everything when you break down wealth and finance about money or financial dollars, or is there other ways that you can build a source of wealth without capital dollars actually?
Yeah, there's many ways. I think the most important thing, because a lot of us are not rich, the most important thing is just budgeting based on your income and your livelihood. It's whether it's putting a certain amount out of your paycheck mm-hmm. on a weekly or biweekly basis to a savings account that, you're not able to access or touch is probably the best way to start. And then once you start to build that up, you can look at different options on diversifying those funds to get the best return on those funds as much as possible. So getting the best interest rates, making sure they're in, for a certain amount of time. So again, you're getting the best return once you're able to build up that savings that, you should be putting away as much as possible, again, based on your livelihood and your income.
Well, in order for any particular financial, and I know you're not a financial advisor, so I'm not going to ask you directly what a financial advisor mm-hmm. firm would actually advocate, mm-hmm. but in order for any individual to manage your money, you have to have a certain amount of money to get started with. I mean, is it a certain base price?
Yeah, well, at times, depending on what type of products or services, you're interested in based on, your research and talking to different financial advisors, there's typically is a certain minimum amount mm-hmm. in order to invest or start a certain account. Mm-hmm. But again, if you're just starting off, having a regular savings to where, a certain portion from your paycheck or you're having a certain amount transferred, at a certain time of the year or a certain time of the month is starting to build it up. So when you get to that certain level, you can start to look into, investing it into a more a more product that's going to give you a better yield of return.
Stephen, should every individual have their money saved or invested in a normal banking account, or is there other avenues that a person should have?
There's definitely other avenues from an investment standpoint. And, you know, it really depends on what you're interested in and what you're trying to do with your money as it relates to, you know, either having it into more of a risk to where, you know, even though there's more of a risk, you're typically with an account where there's more of a risk, you know, if things are working well, you're getting a better return. Whereas you can be a bit more conservative as well, to where you're not going to get as much of a interest rate or yield on that return, but it's a lot safer. So depending on, you know, how much you have and the advice given from your financial advisor or your banker, then, you know, that would determine on how you should kind of set up your funds. I definitely wouldn't recommend putting it all in one place.
Yes.
And that comes from, you know, diversifying your money. But again, when you build it up to a certain extent, you should be getting, you know, that advice and that knowledge from, you know, more than one financial advisor, because depending on who you're dealing with, you know, other folks may offer different products and services that may benefit you. So even if you trust this person and you've been with this person, it's always good to get a second look and see how you can diversify your funds.
How much, again, is your money insured in a normal banking system today? Is it a certain amount of money that you have to have?
Well, through FDIC, as it relates to your money being insured and safe and protected, it's currently $250,000. But, you know, if you have more than that you want to invest in that same institution, there's ways around it. For example, getting beneficiaries on your account, which I recommend if, God forbid, something happens to you. Each beneficiary, for example, would be broken up at $250,000 each. So if you have an account with $300,000 in it, for example, but you have two beneficiaries on that account, beneficiaries meaning, you know, it's payable on death to those folks who are beneficiaries. Then if you have two on there, you're looking at your account being protected up to $500,000, because it would be $250,000 per beneficiary on that account. So it's typically $250,000, but there's ways to increase it so your money is still safe and protected.
When you say beneficiaries, you're talking about a normal life insurance policy?
Not life insurance policy specifically, but, you know, just a regular bank account. If you were, for example, got a lump sum of money and you deposit it into a regular checking account or savings account at the bank, your money is protected up to $250,000. But again, if you're adding a beneficiary to where they would get the money if something happens to you, it's $250,000 per beneficiary. So if you have two beneficiaries on that account is actually protected up to $500,000, for example.
It's always harder for many people to make your first million. The challenge is obtaining money first. Is it more easier to, when you have money, to have your money invested and having it work for you more than being able to make the money?
Yes, that always helps. That always helps is having funds, because not only will you continue to make money, but the funds that you already have built up, even though you're not touching it, based on the interest rate you're getting a return, whether it's monthly, annually, or however you have it set up. But when you have those funds put aside, it's already working for you by just sitting there getting interest. So you're getting a return from that. But in addition, of course, you're continuing to, you know, if you're working or getting some type of income, you're continuing to build more funds in your portfolio. So while that money is to the side, earning interest and kind of working for itself, you still should be continuing to, have a budget and continue to save and build up even more to obviously get more of a return.
Stephen, many young people make many mistakes. Many older people can also make the same mistakes, not really saving and having your money invested over a long period of time. I don't know what the current amount would be, but I'll ask you, if an individual was 18 years old and they started to, let's say, save $100 a week, by the time, if they was to reach 65 years old of age and they was disciplined enough to do that, would they be somewhat of $1 million, you think, and with that amount?
Definitely. Again, the more it builds up, the more you're going to, have in that balance to get a better yield of return. But it's also, again, it's not just having it sit there earning minimal interest. And that's kind of where the financial advisor comes in and getting a second look and second opinion even if things are working well, because again, they can possibly give you a better interest or a better portfolio to have that money build even more. So you can have two people with the same balance, but you can have that one person who looked into getting a better investment and getting a better return and diversifying their portfolio, as opposed to someone who just has it in a regular liquid savings account getting minimal interest. That person who diversified their funds and put it into a product or service that is giving them a better yield will obviously continue to build more money than that person who actually had the same amount but have it just sitting in a regular savings account, for example.
And of course, Stephen, we cannot always predict what the economic outlook or the forecast will be 20 years from now. So even the same amount of money that you have today, it could have a lot different. Inflation could also be looked at towards what your money could be valued 20 years from now. So people definitely have to be aware of a long-term economic outlook and just the overall, dollar rates that your dollars can actually be worth.
Definitely. And that again is where, your financial advisor should be advising you of, things that are coming up down the road based on the insight that they're receiving, and not just telling you, about maybe 1 or 2 years down the line. They should be looking at diversifying it and putting it in different places in order to where 5, 10, 15, 20 years down the line, no one can predict specifically what's going to happen. But again, based on the specific insight and their expertise, which is, their profession, they should be advising on you of, what may be to come and how you should diversify those funds to continue to get the best return.
Okay. Stephen, we up on our first break. I appreciate all of the information that you've been providing so far, and thank you. And we're going to come right back very shortly. Going to get into this record number Powerball drawing that everybody throughout the country is talking about, and get your advice on what you need to do with that amount of money if you're fortunate enough to win.
Excellent.
Okay.
Sounds good.
All right. This is Jonathan Small. I am enjoying hosting Face to Face this morning with my guest, Vice President, Senior Marketing Programming Manager for Webster Bank, Stephen Taylor. We're going to continue right back very shortly with Face to Face. Thank you. Good morning again. This is Jonathan Small. I am enjoying hosting Face to Face this morning with my guests, Stephen Taylor, Vice President, Senior Marketing Program Manager for Webster Bank. We're going to continue back with our conversation. Stephen, over the past week or so, maybe even longer than that, but definitely over the past week, this record this record-breaking Powerball drawing that's been drawing a lot of interest has now been raised right now, currently up to $1.3 billion. First of all, if anybody is fortunate enough to win that amount of money, what should be the first thing that they should do?
First and foremost, sign the back of the ticket.
Okay, that's the logical point.
You don't want to lose it. You don't want to misplace it, or even have it stolen and have someone claim the funds that is rightfully yours. By signing the back, obviously, it enhances the security of it and protects it to where if someone unauthorized tries to present it, they can kind of help to verify that signature and determine their identity. One one really important thing is to, and some states allow it, some don't, depending on where you win it, is try to remain anonymous. I think for obvious reasons, for the mere fact that you may have those long lost friends or relatives that, you know, may come out of the blue all of a sudden and look for, you know, some type of funds from those winnings. And of course, those financial experts as well that may come out of the woodworks to, you know, try to help you with those finances and set you up properly. So I think remaining anonymous is important, although some states don't allow it. If you know, you're in a state that does allow you to be anonymous, I would definitely recommend that. It's very important to see a tax person.
Yes.
They're going to give you the proper advice as it relates to whether you should take a lump sum and kind of what the pros and cons from a tax standpoint of taking a lump sum, or whether you want to kind of break that up into like a 30-year annuity to where you're getting monthly income from that annuity. But again, speaking to a tax person, they'll give you that expert advice on, you know, based on your situation, how you want to, you know, determine to get those funds. I think the biggest investment is paying off all your debts. So if you do have debts, whether it's from school loans, a mortgage, whatever the case may be, for example, paying off all those debts first and foremost is probably the best investment you can make. It's opening you up to more options. You can have all the money in the world, but it's still important to have good credit.
Yes.
And by paying off your debt, obviously it's helping your credit and relieving you of, you know, priorities that, you know, still need to be paid. Taking steps to protecting your assets, in addition to, you know, having an accountant or tax person giving you the advice on how you should set up those funds to, you know, get the money. You're going to want to have an attorney as well. They're going to set you up and give you the advice on not only protecting the assets, but also to, you know, set it up properly to where if you pass away, that money is protected and given to the proper people and not sent off to probate. And, you know, other folks are getting paid off of, you know, trying to, you know, get your money to the right place. It's already set up to where, you know, if you do pass away, it's given to the right people and not exposed to any loss or anything of that nature. Those would be the initial things I would recommend. It's a lot of money. So even though you're to a certain extent rich, you should still keep a budget. It's important to discipline yourself on having a budget. And even though that money may be available to you to spend, you know, you want to keep it to, you know, have it there for safekeepings. And so you can still be set up for retirement. It may seem like a lot of money, but, you know, if you look up some cases, a lot of people still blow that money, believe it or not. So even though it's a lot of money, continuing to keep yourself on a budget is very important so that money can last and grow and be with you throughout your life.
Well, Steve, that gets me to my second question. When you receive that amount of money, first of all, after taxes, a certain amount is going to automatically be deducted.
Correct. Then
all of these other services that you mentioned that you should also obtain, they would have to get, you know, financed or compensated as well. So could you just kind of break down a rough estimate, in your opinion, that if a person wins right now $1.3 million, the time taxes are taken out, all of the other services are being compensated, how much money do you think that individual would have offhand?
Well, if we're talking 1.3 million, billion.
Right.
Okay. Yeah. If we're talking 1.3 billion, you would definitely still be a millionaire, of course. Specifically, you know, I can't say specifically, you know, what you would have because, you know, depending on the type of resources you're using, I don't know what they would charge you, but you would definitely still be in the millions, which is, again, why it's important to budget, because even though, you know, you'd be considered a millionaire, that money can still go if you're, you know, spending it and you're not being resourceful and making sure that it's diversified to where it's protected and still growing.
Well, this automatically puts you in a higher tax bracket.
Definitely.
So you're going to be paying a lot more in taxes on a yearly basis than you would have been if you didn't even have this amount of money.
Correct.
It's hard for people to believe that a person could be worth millions of dollars and end up broke, but you hear these stories all the time. Is it just bad investments, or that people just are not, aware of what they need to do with their money that causes a lot of people to end up losing all of the money?
I think a lot of it is knowledge, or lack of knowledge. And again, I use an example of it just sitting in a regular savings account and not earning any interest or any return, and you're just spending.
Okay.
Whereas if you're budgeting and you have a certain amount of money put aside and it's getting a return, then again it's kind of out of sight, out of mind, but it's still continuing to build. And if you're budgeting and only using the money that's within your budget, then you're still getting that return, and you're still able to have a livelihood and have income to live your life. So it's very important to make sure that you have that financial help and that financial literacy to know how much you need to put aside and know how much you need to budget to continue to live your life, but also be set up for the future.
When you also talk about financial advice, you hear many times annuities, mutual funds, stocks markets, or buying stocks and bonds. There's more risk, obviously, when you're talking about stocks and bonds.
Correct.
But with that amount of money, do you really need to be investing in stocks and bonds? I mean, what would be the best source to invest? Let's say after taxes, after compensations are paid, about 400 to 500 million. What would be the best recommendation you could tell somebody to?
I think the best recommendation would not be one product or service. I can't say specifically what would be the best for you, but again, when you're speaking to your financial advisor and you have your accountant, they're going to give you options to put it in, and by diversifying it and having it in different places, if things aren't working well in one place, you're able to make adjustments and put it to where it is working, to where if you just have it in one place and things are going so well for that one product, you can be not earning as much as you deserve to be earning with those type of money. So my recommendation would be to make sure that it's diversified and not just sitting in either one product or service or in a liquid savings account that isn't, giving you too much of a return from an interest rate standpoint.
But again, and you work in the banking industry, so obviously you're going to advocate that everybody should always have their money in a banking system.
Correct.
More than not having your money in a banking system.
Correct.
But when you put your money into a banking system, let's say a large amount of money, if your money is just sitting there, it's just really helping the bank make money off of your money.
Correct.
Okay.
You're right. You're right.
All right.
But again, if you're investing it where there may be some risk, but there's different type of products and services that have lower risk and more of a risk. The more risk, I think, in general, you'll get more of a return. But again, yeah, if it's just sitting there not earning any interest, the bank is actually pretty much using that money to get interest.
Yes, man.
But also, if you're looking at options and making sure that you're staying on top of things, getting the best interest rate possible, and that takes, looking around, looking at what options are available to you, and not just kind of taking the word of just one person. But it's important to, not just shop around, but speak to different financial advisors and see what they're able to offer, because it may be better than, what you're currently in.
All right, now in 2016, what's the overall status level of the United States banking system?
I would say it's getting better from an economic standpoint. If you're looking into the news lately, you're seeing interest rates start to go up slightly, and that's important as it relates to getting that return.
Yes.
So CD rates, for example, which is certificate of deposits, to where you're putting your money in for a certain amount of time, whether from 1 month up to 5 years, were very low. But you're going to start to see those creep up now, to where if you lock it up for a year, for example, you're getting a fixed interest rate. That money can't be touched for a year or you're penalized, but you're getting a specific interest rate, which is locked for that specific term. And again, you're getting a return from those balances that are in the CD to, start to build up your portfolio and start to build up your savings.
And again, you just mentioned a portfolio, which is very important that people have. But again, you don't have to really always be rich to have a portfolio.
Not at all.
Not at all. Okay.
Not at all. And that kind of goes back to, I'm a big fan of just budgeting. So however, your livelihood is whether you're a young teenager or you're an older person, it's making sure that you're budgeting a certain amount to continue to live your life, but everything else is you're kind of putting away. And if you haven't saved up a certain amount to put in a product or service, by budgeting and starting to build that up, you'll start to get that balance to where you can put it in something that will get you a better interest rate. But whether you have, a huge balance in your account or you're just starting, by budgeting and transferring that money to a certain account to where it's out of sight, out of mind, you'll start to build it to where you can put it into something and get more interest.
Well, again, we're doing so well. You're doing so well, providing a lot of very important, knowledgeable information this morning. We're up on our second break.
Okay.
We're going to come back into the last segment of Face to Face. I'm going to ask some more questions about the overall benefits of financial wealth. I want to get into some pros and cons of what people should do with their money again. And I appreciate you providing this information this morning.
Thank you.
Okay. Again, this is Jonathan Small. I am enjoying hosting Face to Face this morning with my guest, Stephen Taylor. He is a senior vice president, senior manager programming program. Oh boy, this is the first time this ever happened.
That's
Got your title a little mixed up.
Senior marketing program manager.
Senior marketing program manager. Right. Yes, I've been doing so well up until this point. But again, we're going to come back with part 3 of this show, and I appreciate you again providing this information.
Thank you.
Okay, Jonathan, we'll be right back very shortly.
AccessTV.org. Stay tuned.
These are the monsters of the road. Ever drive alongside a tractor trailer in the rain? Scary. You're hoping they don't change lanes. Now they see you, now they don't. This monster can crush you in an instant. They may be insured for millions, but you're not thinking of that in a dangerous situation. I'm attorney Jeffrey Dresden. Have an accident, you know what to do. Because this is what we do. 24/7, 11/22. Black History Month. We pause to acknowledge and appreciate contributions enriching our cultural and intellectual fabric. Keep it coming.
We are the members of the Heritage Boston Dance Theater, and we celebrate Black history 365 days of the year.
Again, this is Jonathan Small. I am enjoying hosting Face to Face this morning with my guest, Stephen Taylor, Vice President, Senior Marketing Program Manager for Webster Bank. We're going to continue back with part 3 of our conversation. Stephen, I remember a long time ago, not so much I remember directly, but indirectly listening to different sound bites. Like, 40 years ago, 45 years ago, people would say if you had $1 million, you was extremely rich. They couldn't envision even making $1 million. Today, we seem to have a lot more millionaires today than ever. But on average, $1 million, let's say in 1975 would be worth, or 1970 to 75 would be worth how much today in today's dollar?
Ooh. A lot less.
A lot less?
Obviously, I think the main thing due to that is inflation. But you're probably looking at a quarter of that. Yeah. And again, depending on your plans with those funds, obviously would make a huge difference whether, you're diversifying it properly or if you're just spending away without getting any return on those balances. But I would say probably about a quarter of that being in 2016.
So that's really saying like $1 million today couldn't do many things that $1 million could have done in 1970.
Correct. Correct. Yep.
So that means you actually need more money than to do the same amount of things that you would have did with the same million.
Yeah,
okay.
Definitely. And I think again that really just comes from inflation and the cost of living. But you've heard me say this a couple times, and I'm just a firm believer of it, is making sure you have someone to help you create a budget. So whether it was, whether it's $1 million, whether it's $250,000, if you have the right financial advice to get a budget for yourself that is still within your means of living, but you're able to save from it, it's important. It's going to last for you, and it's going to continue to grow. So even though $1 million in the 70s is was worth a lot more than $1 million now, if you're planning accordingly and getting a return off that investment, it will continue to grow regardless.
And Stephen Taylor, again, I don't want to put anybody down. This show is not about trying to make people feel ashamed if you're not well off financially, but obviously society puts a lot of emphasis on wealth, whether it's good or bad. But the reality of, let's say, home ownership comparable to renting, is there a lot better benefits of being a homeowner comparable to a renter? Could you kind of break that down?
Sure. First thing I'll say is nowadays, if you're paying rent, with how low interest rates are, and purchasing the home and in that market, you're probably paying this similar amount than what you would pay for as compared to what you would pay for a mortgage. So it's very similar in what your rent would be in regards to what your monthly mortgage would be, depending on obviously the value of the home and how you created your mortgage. But it's very important, which is why, even if you have $1 million, it's very important to have good credit still. Because even though you can pay for a house with that $1 million, if you want to save that $1 million and not spend it all in a lump sum on a home purchase, for example, you're going to want to get approved for a mortgage. And without good credit, you're not going to be able to get that mortgage. So even though you're considered a millionaire, it's still very important to keep an eye on your credit and make sure that, that credit score doesn't fall to where you wouldn't be eligible for a mortgage. So keeping a good credit and getting a mortgage as opposed to spending, $1 million in one lump sum on a home is very important. So, you can be a millionaire, but it's also important to continue to budget and make sure that, you're taking care of your credit and paying off your debts.
Is home ownership a form of wealth? I know it's a form of certain status levels for what particular home that you own. But if somebody in the banking systems and you tell the person that you are a renter and the difference between a renter and a homeowner, do you as a banker look at the person as a different level of their wealth just by owning a home?
Well, it helps because especially if you have a home with equity in it, that's pretty much giving you an option to have funds.
All right.
For example, there's certain type of loans in the bank called a home equity loan, and you're really getting the money that's available to you from your home. So just a quick example, if your home is worth $200,000 and the balance on your mortgage is $100,000, then the difference would be $100,000 that you have available in equity. So that's another means of getting funds, is through the equity of your home. Whereas obviously if you're renting, you don't own that. So there's no way to gain any type of equity. You're kind of just giving your money to someone on a monthly basis and not seeing anything from it.
Yes.
So it's very important. That's a major difference as it relates to owning a home compared to renting an apartment.
Stephen, also in the economy, I know people budgets are differently because if you make more, you have to pay more in taxes.
Correct.
Usually what you purchase is a lot higher because you just feel you have the financial means. But at some point in society, do we have to be honest and tell people that if you expect to have somewhat of a good quality of life, to be able to do the things you want to do, you have to have your money pretty much not only having money, but you have to have your money working for you. You just can't rely on one source of an income.
Correct. And again, even if you do have one source of income, there's other means to access funds and have funds available to you. Again, even outside of the equity example that I just gave, in your home is making sure that, again, and this is something I mentioned earlier as well, is just making sure that you're budgeting within your means. If you have a certain amount of money that you're not using or you're not spending based on your your everyday life, is making sure that that money is working for you, making sure that you're not accessing it, you're not tempted to get it. I tell people this at a young age, and even at an older age, always look at needs versus wants. There's certain things that you need, and there's certain things that you don't need, but you may specifically want. And no one, if it's something you want, you don't need it.
Right.
So making sure that you're disciplining yourself to not always attract yourself to the wants, but again, within your budget, making sure that, the needs are taken care of. And if you do have extra within that budget without having to go into your savings or portfolio, then, by all means, get the wants as well. But, you have to discipline yourself to stay within that means and within your budget and not, access the money that you're trying to save and build to get a better return in the future.
And Stephen, also throughout our economy and throughout our society, we don't always see in certain neighborhoods, particularly in the cities, you see check cashing sources or check cashing places instead of banks. What is the downside of just having check cashing places in an area instead of having a bank?
Well, there's a few things. If you go to a check cashing place, they're going to charge you a certain percentage based on the amount of your check. So that right there alone, you're giving away money that you hard earned without even seeing it.
Right.
Outside of that is you're cashing your check, you're getting the money, you're putting it in your pocket, you're keeping it under the mattress in the house. For one reason, it's not safe if you're doing it that way.
Right.
It's safe at a bank. And you're not earning any interest at all. You're not putting it away to, again, have it maybe automatically transferred over to a savings account to where you're starting to build. It's not safe and you're not getting any interest from it. So God forbid, there's a fire in your home. It's not insured. It's not safe. It's gone. There's no track record of it. And, again, that hard earned money that, you're getting from cashing a check is at your house, and there's no way to track it if there's damage to it or something happens to it, to where, again, at least if it's in the bank, even if you're starting to build up, and because you're starting to build up, you're not getting that much of a return, it's safe.
Right. But Stephen, also, when you have in a society or neighborhoods check cashing places and less banks, doesn't that automatically devalue that particular community? Because when investors and people who are looking to invest money in businesses, don't they look at a neighborhood and see if you have a check cash in place instead of a bank, that there's somewhat of a risk just to invest your money in that particular area? Correct.
If there's not a bank in that area, and I wouldn't be able to give a certain radius because I don't know how that's determined. But if there's not a bank in your area, they look at it as it not being worth having a bank there. Or it may be another reason to where, for example, there may be another bank kind of within that radius, maybe not specifically in that neighborhood, but in that area that people in that neighborhood could still access. You'll start to see banks opening new branches and a footprint to where, they may not be, and you'll see them maybe close a branch to where they have 3 or 4 branches within 3 or 4 miles of each other. So, I mean, it's important to have a bank in your area because they do look at those type of things.
Yes.
Especially investors and people, looking to establish businesses in that area. But, a lot of the time, I think, there's still going to be a bank in that radius, may not be in that specific area, and they may even close a branch in that area. But I think a lot of the reason is more along the lines because there's still that bank in the, kind of in that radius, and they're still able to, take care of a customer. And especially nowadays, a lot of banking is done online through your mobile phone, at ATMs, that, over the phone, to where you can do a lot of the stuff nowadays that you can do by going into the bank as well.
Yes.
So a lot of those things are taken into consideration when, not only branches are closed, but when branches are being established in different areas.
And I know, Stephen, this morning we talked a lot about individuals, what you need to do with your wealth and money. And also we didn't even mention too much about your time, because your time could be just as valuable, if not more, than even how much money that you have. But one last question, because we're actually out of time. I just want to get this in.
Sure.
If an individual, let's say, is looking at their best overall investment, many times I always hear a person will look at the school system. That's a good sign. You would look at the crime rate. That's another sign. But as an individual, if you're looking to get the best return on your investment, your life, you have to honestly look at the community that you're moving into to see if it has less businesses, less goods and services, that area automatically could be a risk, or is that a red flag? Do you have to really look at the whole community for your best overall investment?
Not per se. I think not to get off the subject. I think if you're in that type of community, then it's important to kind of do your part and help overcome those certain obstacles. But I think it's really based upon the individual to start.
Yes.
And the reason why it's based on the individual to start is because it's based on your income. So you're getting this specific income. It's up to you to make sure that it's handled properly. But again, from a community standpoint, is if these type of obstacles are in place, I don't think it would, affect you negatively as an individual. But I think, you should really look into what you can do, how you can do your part to help whatever the situation is.
Yes.
So if it's businesses, for example, not being in the area, what can you do? Who can you reach out to? Whether it's, the city council, whether it's the Chamber of Commerce, or anyone in that area, as to what you can do to help start to build businesses in the area.
And again, this might be swaying away from what we were really talking about for the focal point. But I just feel as an individual, when you're talking about getting the best return for your dollar, getting the best return for your investment, also you got to look at your overall body, your family, what
Definitely
you're able to interact with throughout your life to see where you're going to get your best investment at on that level too.
And not only that, it's in that area, it's because you mentioned family, kids, of course, is what options are available to them to develop them as individuals to be successful in the future as well. And again, I think all of that comes from community and what you can do to help the community depending on its issues.
Yes. And this is not a one-step process. I mean, it takes a multitude of different things to build a viable community. I don't want to give people the impression that this is an easy thing to have everything that you need in your community. There's a tremendous process that goes into this. But like you mentioned, everybody got to be willing to do their part. Okay.
Yep, it's important.
And very important. Stephen Taylor, we could go on a lot longer, but we're out of time. But I appreciate the time that you have been able to give this morning on this particular topic on short notice at that. So I really appreciate that. And again, I wish you the best of luck with your future and your particular goals. And hopefully we can meet again at some point.
I'm sure we will. I appreciate the opportunity.
No problem. Thank you. This is Jonathan Small. I had just enjoyed hosting Face to Face this morning with my guest. He is the Vice President and Senior Marketing Program Manager for Webster Bank. And I was very informative and receiving a lot of very good information. I hope the people out there were also appreciative of this particular show. There's other programs that you could always look at on accesstv.org network throughout the day. This up and coming week, I'm going to be doing another special of Face to Face this particular Thursday. Hopefully I can have All About You wrapped up and definitely give you some more heads up on that particular show. I hope you'll find that show very enlightening too. But again, until I see you again this up and coming week on All About You, for people out there, have a very peaceful day. Thank you.